Hey traders, Raghee here, and in this free recap video, we're going to talk about one of the markets I get the most questions about, and that is crude oil. So let's take a look at the November contract of crude. That is currently the front month. So as we take a look at November crude, the idea here is that do we have an uptrend? And let me talk about what, for me, denotes this uptrend. The consistency of the green grab candles and also the upward slope of the 34 EMA wave. Now, the 34 EMA wave is simply 334 period exponential moving averages on a high, a low, and a close. Okay, and these are free tools you can get in the TradeStation Trading App Store. We have this available for Thinkorswim, TradingView, a number of places. So when we are looking at, again, November crude, a couple things to keep in mind. And this is something that tactically will be not yet something we need to worry about, but we're closing in on it. So this is one of the reasons we're going to be talking about crude oil. You'll notice that open interest, if you're a futures trader, open interest is something you need to watch. We are, as of really today, really yesterday, inside the 2-week window before we roll into the December contract, because CLZ, the December contract, is technically the front month, really in terms of open interest, soon. When we are 1 week out from the CLX November contract expiring, you're going to see increasing open interest in the Z, the December contract. So keep that in mind. We're inside that window. Now, why is that important, and why is that, in my opinion, quite bullish? We're going to see that the X contract is going to see some selling pressure. We're going to start to see a little weakness. Why? Because think about it. If you're going to get out, if you're going to get flat, if you know this contract is going to expire, to get flat, you need to do what? If you're long, which I would say you have a lot of market participants who are long, what you're going to notice is they're going to have to sell to get out of that long position, and then they're going to go buy that Z or December contract. So you might see a little bit of selling pressure here before you see a resumption of the uptrend. And that uptrend would play out on the D's contract. Now, here's another thing, and we'll probably talk about this more towards the end of the week, and that is the COT, or commitment of traders. How many hedges are out there? Because most hedges are going to be positions that are short. If you're going to short an uptrend, you're going to have a short, if you're playing an uptrend, the hedge would be a short sell or being short this market. So how many of those are going to get out of their hedge position only to go and short the December contract? Now, the best way to understand that would be looking at something like the COT data. And that is something we'll talk about as we get closer to the end of the week. COT data comes out after the close on Fridays. Now, I can tell you there's a good bit of short interest right now, and mostly the place that I've seen it the most is in the XOP. There's actually a pretty good move in short interest on the XOP, which is the Oil and Gas Explorers. This one, right? This contract right here. So there's a lot of interesting moving parts in crude. We'll talk more about that. So the first thing I want to bring to light is the fact that we're rolling from November to December. And when I put on the next crude oil trade, because we are currently long the November contract of crude. We just currently got long again the November contract just last Thursday. But as we roll forward and we're inside that 2-week window, we're going to start moving to the December contract. So if I want to be in this longer term, maybe days or weeks, we want to be in the December contract so we're not inside that expiration window. Now, what am I looking for? Well, the next thing to talk about is what is happening with the API to EIA reaction. So one of the things you'll notice in crude, and I'm going to go back to the CLX contract, is that what we want to notice is when we have a move in crude on the API, and it's very important to watch this kind of information because API actually, as of, I believe, let's take a look. Well, actually, the narrative that's dominating today is really not an API narrative. It's actually the oil prices based upon Iranian crude oil exports falling, as well as Hurricane Michael nearing the Gulf Coast, which I don't believe is going to be a major crude oil event because we're not necessarily, I think we're just going to skirt right by some of the refining plants that are along the refiners that are along the Gulf Coast. About 50% of the refiners for the U.S. are along the Gulf Coast. I don't believe that's going to be a major situation, but we are seeing fewer barrels of Iranian crude. Okay, that's something we'll talk a whole lot more about in the premium video. Not to mention the U.S. Gulf on Tuesday. You know, we're seeing a production cut. It's going to be temporary, but about 40% as Hurricane Michael is approaching the Florida coast. So this is about reporting from about 27 different companies. It shouldn't be a long time, but there is a little bit of an impact on crude and natural gas. We'll talk more about that. I kind of digress, but there's a lot of moving parts to crude. So number one, keep an eye on the rollover from November into December. Number two, think about how that commitment of traders data this Friday could help us position for timing on the next buy for crude oil. And three, what is going to be the reaction? How can we play the EIA volatility tomorrow? Now, for my free video, folks, I typically look for a $2 plus move that I'd like to take advantage of. Meaning, I'd like to see a $2 sell-off at minimum before I step in and buy crude oil. So keep that in mind. That should help you a lot. When you're looking at a projected low, look for a potential 2-point or $2 move. All right, I'll see you in the next update.